So Andrew, we have been doing our series on different types of retirement plans, talking about the pros and cons, the similarities and differences between those plans, such as a 401k versus a 457b, or traditional IRA versus a Roth IRA. And what we are starting to realize, Andrew, and I think you see this, more and more people are appreciating our style of teaching because we are educating them as opposed to trying to sell them any particular product or sell them on some fancy investment idea. That is not what this channel is about, and that certainly is not what the Retirement Education Center has been built on. And so we're going to continue that theme today in our video when we're talking about a qualified annuity versus a non-qualified annuity. So no matter who you are out there tuning into today's video, at some point in your retirement life, you're probably going to be faced with the ideas of if you should buy an annuity or not. And you should know a little bit more about these products. And so that's what we're going to cover in today's short educational video. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason we've created these educational videos is to help to make the difficult and confusing process of retirement simple.
Absolutely, Andrea. And we do this simply by utilizing our team of strategic partners, ranging from certified financial analysts, certified financial planners, estate attorneys, insurance advisors, and other needed professionals to assist us in building a comprehensive and holistic retirement roadmap that's going to let our clients know when, where, and how they can reach their retirement goals.
For specialized strategies on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So Andrew, when you purchase an annuity, what you're basically doing is that you're purchasing an insurance contract from an insurance company.
So is that like purchasing a life insurance policy?
Not exactly.
Okay.
And so if you have that question, I'm sure thousands of people out there that may be tuning into this video will have the same exact question. So what we're going to do is probably make a video about that, the differences between an annuity and a life insurance contract. But it's not quite like that. With an annuity, what you're going to do is that you're going to give a certain amount of money to an insurance company. And in return, that insurance company is then going to pay you, money or income for a period certain, like 10, 20, or 30 years, or for the remainder of your life and even your spouse's life. So most annuities are similar in that fashion, but they can be sheltered differently. So you can have qualified annuities, and you can also have non-qualified annuities. And that is what today's video is going to be about, to make sure that you can distinguish between the two, because they do have some really great similarities, but they also have some unique differences that you should know about as well. So we're going to cover that in today's short educational video. But before we do that, Andrew, what are our 2 rules for retirement income that we always give those who are tuning in?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
Great. So let's go ahead and talk about the differences between a qualified annuity versus a non-qualified annuity. So let's go ahead and now talk about the differences between a qualified annuity versus a non-qualified annuity. Of course, I'm going to always point out to you that we're only going to be talking about for 2021, because more than likely, if you're watching this video in another time in the future, of course, a lot of these things could have changed. But for 2021, we want to first start off by talking about how a qualified annuity and a non-qualified annuity, how they are similar. Well, one, both of these type of annuity structures are going to offer both a tax-deferred growth opportunity for you. So if you put money into a qualified annuity, or if you put some money into a non-qualified annuity, the earnings on those dollars are going to be able to grow tax deferred, and then you would have to pay taxes on the back end when you start taking those dollars out. Also, they will both offer you a lifetime guarantee. So if you're looking for lifetime income, if you're looking for a paycheck in the mailbox every single month, a qualified annuity or a non-qualified annuity will, of course, suffice. Both of these type of annuities you can pass on to your beneficiaries of your choice. So if you have kids, grandkids, or of course your spouse, if you just label them correctly on the beneficiary form, you can actually pass these type of annuities on to your beneficiaries. Also, if you're looking for a payment, much like if you had a pension, you can actually have a payment not only go to you for the rest of your life, but also to your spouse for the rest of his or her life as well. So keep that in mind. If you want to make sure that this income that you're getting from a qualified or a non-qualified annuity is going to last for your lifespan and your spouse's lifespan, you can do that with both type of annuity structures. Also, keep in mind that you would have to pay an early withdrawal penalty on a qualified or a non-qualified annuity if you take that money out before age 59 and a half. That's very important to make sure you understand, because no matter what your situation may be, we're going to always try to encourage our clients to at least wait to take money out of any type of retirement plan, so they don't actually have any type of additional penalty along with any type of taxes that's going to be awarded to that distribution as well. So be careful about that if you're going to take that money out before age 59 and a half. When we're talking about a qualified annuity, it's going to be on the contributions and earnings. If we're talking about a non-qualified annuity, we're talking about the earnings only, because this money has gone in after tax. So it's only going to be on the earnings that you would have to pay taxes and a 10% penalty on before age 59 and a half. Also, both of these plans will require you, as we mentioned before, to pay taxes upon distribution. Now, there is a special tax treatment for non-qualified annuities that we're going to cover here in just a moment. But just understand, even though you pay taxes on that money in a non-qualified annuity, the earnings will have taxes taken out from it. But there is a special tax treatment when it comes to non-qualified annuities that other vehicles do not have. It's not like a Roth IRA when you put money in that's been taxed and then the growth and earnings can be taken out tax-free. A non-qualified annuity works a little bit differently. So let's go ahead and start talking about these differences so we can understand this a little bit better. As we mentioned, they have some similarities, a qualified and a non-qualified annuity, but obviously there are some differences here. When it comes to a qualified annuity, it is funded with pre-tax dollars. So if you had a defined benefit plan, like a pension, that money is going to be qualified dollars. It's going in pre-tax by your company that you're working for. If you have a defined contribution plan, you're putting money away, like in a 401k or a 403b, 457b that we've covered on other videos. You're putting that money away as well, pre-tax dollars. And then when we're talking about IRAs, like traditional IRAs, that money is also considered qualified dollars that you're putting in pre-tax as well. Non-qualified annuities, you're funding those with after-tax dollars. So your money has already been taxable when we're talking about going into a non-qualified annuity, not pre-tax dollars. Qualified annuities, you must have earned income. So you cannot participate in any type of qualified annuity plan if you're not working, if you don't have earned income. That is not the case with a non-qualified annuity. You do not need earned income in order to put money away into a non-qualified annuity. So that's really unique when it comes to other type of plans that you're considering. If you're thinking about an IRA or Roth IRA, you always have to have some type of earned income in order to contribute to it. But you don't have to do that with a non-qualified annuity. Qualified annuities also have IRS contribution limits. Now, this is really, really important, and this is a huge difference and a huge advantage when it comes to a non-qualified annuity. Because with a non-qualified annuity, you do not have any IRS contribution limits. So if you want to put $10,000 a month or $100,000 a month inside of a non-qualified annuity, you can do that. You don't have the restrictions that you will have on other types of qualified plans that are out there. Also, with the qualified annuity, you have to abide by taking the RMDs out of those accounts by the age of 72 if you're no longer, of course, working with those companies when you're talking about your 401k plans and your 403bs and 457bs. But when you're talking about IRAs, you have to take that money out with RMDs by the age of 72. When it comes to a non-qualified annuity, there are no rules of actually having to have a distribution come out of those accounts. So you can literally leave those dollars in there as long as you like. Let them grow tax deferred and decide when you want to start taking those money out. A qualified annuity, as we mentioned, when we're talking about the taxation of qualified annuities, the contributions and earnings are taxed as ordinary income. When it comes to non-qualified annuities, the earnings only are taxed as ordinary income, But we have this unique thing when it comes to non-qualified annuities known as the annuity exclusion ratio. Now, we probably need to do a video on this because it's really unique. Of course, you'll want to check with your annuity company about what the annuity exclusion ratio is with your particular contract if you have an annuity. Of course, we can help our clients with this, and or you if you're looking for someone who specializes in helping people understand how to operate inside of an annuity. But that annuity exclusion ratio is really unique because anywhere from 70 and sometimes 80% of the money coming back to you can be literally tax-free through that annuity exclusion ratio. So which type of plan might you think is better for you? Let's cover that real quickly here. If you want to invest your money without any limits and have the protections that annuities can bring with it, and have, of course, a lifetime income guarantees that annuities can bring with it, if you want to be able to fund an account like that without any type of limits, understand that a non-qualified annuity is going to be more suitable for you because, as we mentioned, qualified annuities do have limits set by the IRS that you can only put a certain amount in per year. If you're looking for tax deductions, if you say, I want a tax deduction on my income, well, we know that qualified annuities are going to be more sufficient in this category because contributions made to qualified annuities can be made with pre-tax dollars. Therefore, if you are making $50,000 a year, you put in $10,000 into your qualified annuity at your work, then you're only going to have to report income of $40,000. So you have a tax break there. If you don't have any working income, a non-qualified annuity is going to be the only choice for you because there is no income requirement when it comes to a non-qualified annuity. And if you want to avoid any type of mandatory distributions, then a non-qualified annuity is going to fall in that category as well because there are no R&D requirements when it comes to non-qualified annuities at the age of 72. But if you want a guaranteed paycheck for life, if you're looking for an annuity for that purpose only, then any of these types of annuities is going to be sufficient for you. So any type will work for you because both a non-qualified annuity and a qualified annuity will provide you an income for life. So no matter what your situation may be, you're going to always want to consult with your own financial advisor or tax advisor, or of course contact us to make sure that we can talk about your individual situation so we can really map out what's going to be best for you. So I really hope that this educational video gave you some insight into the differences between a qualified annuity versus a non-qualified annuity. Please understand that these videos are created for educational purposes only, and that you should always consult with your own financial advisor or tax advisor about your personal situation. For more information about this topic or any of the topics that we've covered on our other videos, please feel free to reach out to our office for personal help, and also make any comments or questions in the comment section below.
To learn more about our services and how we can help you to increase the chances of not outliving your retirement savings, please make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, please check out our other videos that we've created that will help to give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.